Today we're going to talk about long-term care rider. Up until last week, we talked about chronic, critical, and terminal illness. So it was a living benefit, but today we're going to talk about long-term care rider, and we're going to see what it is, and we'll see. We'll dive in a little deeper this time, and because I'm going to actually break down one of the best long-term care rider by One America, their illustration, and I'll explain each item by item. So at the end, if you have any question, you're free to ask me that question. All right, to begin with, let's talk about how much does it cost to be having that long-term care condition. What is a long-term care condition? Long-term care condition is either you have cognitive impairment, which means like a dementia, Alzheimer's. So you have some you're danger to yourself because you gotten old, or you don't have to be old to have the Alzheimer's. It could happen to young people too, but that's one condition. And another condition is, as you know, 6 activities of daily living. Remember, as you get up in the morning, you do your business, toileting, you take a bath, you put on the clothing, and you eat breakfast, lunch, and dinner, right? Eating, and then you move about, transferring, and then sometimes you have to hold going bathroom because bathroom is occupied or bathroom is a little bit of distance. You have to hold going bathroom. It's called continence. These are called 6 activities of daily living: toileting, bathing, dressing, eating, transferring, and continence. If you cannot do any 2 of those 6 for more than 90 days, by definition, you do have long-term care condition. That means there has to be somebody who takes care of your daily living. It's a little different than health insurance, because health insurance will make you well. It treats your condition, medical condition. Whereas a long-term care, we're talking about your daily activities. And contrary to what a lot of people think, health insurance does not cover your daily activities. The health insurance will cover for your treatment, but it doesn't cover for your going bathroom, paying for your caregivers, and things like that. So that's when we need to look into long-term care condition. Um, in average, California costs about $6,944, which is almost $7,000 a month to be taken care of by caregivers. It could be informal care, which is about informal care is about 6,346. Home care costs about 5,722. Assisted living costs about 5,591. Nursing home costs about 10,120. We're so lucky we're living in the state that has high expense of everything. Comparing that to our neighboring states, Arizona, their average isn't that low either. It's a $5,401 a month. Informal care, 4,674. Home care, 5,117. Assisted living, 4,543. Nursing home, about 7,270. So these are the actual numbers. So how do we cover this? We talked about chronic illness, and as I said, we're going to talk about long-term care rider. Very big difference between long-term care rider and chronic illness rider is most of the time it had to do with how you spend that claim money. If you have a chronic illness, and you have insurance that'll cover chronic illness costs, more than likely that insurance plan is indemnity plan. What it means that they'll pay you that set amount that's written in the contract because you have that condition, either cognitive impairments or you cannot function 2 out of 6 activities of daily living on your own for more than 90 days. So you have a condition, they'll give you money, and you can spend money any which way you like. Whereas most of the time, long-term care is what we call reimbursement program. It covers the incurred costs because of your condition, like paying for caregiver, paying for facility. So it is a little different. I mean, we talked about this before. If you have a chronic illness and if you want to go back to your home country, you can with chronic illness, but you cannot do that with long-term care rider because long-term care rider is not an indemnity plan. That's something to think about. Now, even then, we had to look at the long-term care expenses also. And a lot of times, as far as I know, I don't see any chronic illness rider that pays beyond your initial death benefit. As we will see today, the long-term care rider by One America, you can have unlimited benefit, which can be more than your initial death benefit. That's what we're going to be looking at today. All right, here's asset care. This is life insurance-based long-term care, long-term care rider. So, and you can have a life insurance base or you can have annuity base. But in California, I think it makes more sense to go with life insurance base. This particular one, I designed it so that you'll pay only 20 years of premium. So premium stops at 20 years and you have a lifetime coverage. This is a whole life policy. This is not universal life, so premium will never increase. Whatever it is set, it is set. So 20 pay. And I designed it so that it'll cover both husband and wife. It could be husband and wife. It could be father and son or father and daughter, mother and son, mother and daughter, or business partners. It does not have to be husband and wife. So it is called second to die policy. So life insurance side, it only pays the death benefit when the second person dies. In our example, either John or Jane, when they die first, there is no death benefit until the second person, the survivor, dies. Let's say John dies after he got insurance for several years. There's no difference in the policy. Jane still need to make a payment. But when Jane dies, that's when the life insurance kicks in. That's what we call second to die policy. Now, can we do single life with the One America? Yes, we can. We can do single life. But I think it shines more when we have husband and wife cases or when we cover 2 lives. So that's why I picked John and Jane Doe. So I designed it so that long-term care benefit is a $5,000 a month for each of these 2 prospect client. Initial premium on this annual premium is $5,686. That'll get us $166,667. Assuming John is age 45, non-smoker. Jane is age 43, non-smoker. And total long-term care benefit balance is unlimited and it covers lifetime. You will not find this on chronic illness rider. Okay? Not now, maybe later, but not now. Okay? So the death benefit only pays out when both of them dies. It does not have to be death at the same time, but one dies, the policy still continues, and when the second person dies, $166,000 being paid out to the beneficiary. Now here's the death annual premium. Here's the death benefit. I just explained it to you how death benefit will be paid if both of the insured died. When the second person died, that $166,667 of death benefit will be paid out to the beneficiary. That's normal as any other life insurance product. Now, if either Jane or John is struck with a long-term care condition, 2 out of 6. Now, if either one gets long-term care condition, very first thing that's going to happen is that he or she can take out $5,000 from this $166,000 of death benefit about 33 months. In about 33 months, what's going to happen is that $166,000 will be gone, right? You spent all your death benefit, so you do not have death benefit anymore. But this Jane, let's say Jane is the one who had a condition. Jane still need a care. So what I done is that I designed this so that continuation of benefit rider is also in the policy, which means after the client deplete their initial death benefit, they'll still get the long-term care cost rider coming in, so it'll continue paying the $5,000. Okay, that's how it works. Now, what if both John and Jane used up $100,000 in long-term care costs, and they both pass away? The beneficiary, probably their children, will receive $66,000, whatever is remaining. But if either or both of them used up all $167,000 because of their either of their long-term condition, they'll still get the long-term care benefit, but the beneficiary will not get anything because somewhere around $167,000 is already depleted by making payment for long-term care condition. Okay. So we're looking at this. Long-term care limit, so $5,000 a month, which is equivalent of $60,000. But not only one person, but it covers both John and Jane. Whoever is on the second to die policy, both of them will have long-term care rider. This is very rare with chronic illness rider. Chronic illness rider, even if you purchase survivorship UL or IUL with a chronic illness rider, they normally pays only one person. Normally it's a second person. First person, when they struck with this condition, they need to use their own money to cover that condition. But this particular one, if one gets the condition, $5,000 will pay, and when the second person gets the condition, additional $5,000 will be paid out to both of them. So for both of them, we're looking $10,000 a month benefit coming out, which is equivalent of $120,000. Once again, it's a $60,000 per person. Okay. And how much does it cost? I told you it's a $5,686. But if you break down this $5,686, what you will see is that life insurance alone, whole life alone, will cost only $3,745, assuming that you're only making 20 pay. After 20 pay, you still have a whole life policy. Now, remember I said that just in case they outlive this death benefit with the long-term care condition, they still have benefit coverage for the rest of their life, which is called continuation of benefit riders. Now there's this rider is not free. You have to pay $1,941 a year. So if you add 1,941 plus 3,745, you have a 5,686 a year premium. Now on either one of this premium, even though you're only making one payment, but if you break it down, it is guaranteed not to increase the premium. Premium is guaranteed. Premium is guaranteed. So premium is guaranteed. This is a very, very good features because more than likely, if you're looking at pure long-term care insurance, the premium increases as you get older, but not with this policy. And especially since this is on whole life chassis, premium is guaranteed and cash value is also guaranteed. Okay, but don't get into this because of cash accumulation. You wouldn't get much of cash accumulation. Okay. Once again, there's a death benefit of $166,667, just in case both of them didn't get to have long-term care condition and die. They'll still get their family will still get the death benefit, and the benefit amount is unlimited. So they're covered for more than $167,000 if they got into the long-term care condition. And this will show you the premium guarantee. Premium will stop. You don't have to make a payment after 20 years, but you'll still have death benefit and you'll still have long-term care rider. You'll still have continuation of benefit riders. Still going. Okay. Now, what if you want to lower your premium by making a payment for whole life? Can you do that? Yes, you can. The premium payment option on this product is a 10 pay, 20 pay, continuous pay until you die, whole life pay. Okay. So what I'm going to do next is that I'm going to run an illustration for whole life pay. So premium will be paid for entire life until they die. The whole life side is a 2,622. I done the same thing for COB riders, continuation of benefit riders. Same benefit, everything stays the same, except that we're planning to make a payment for the rest of their lives. So that COB rider costs about $1,291. So $1,291 plus $2,622 is about $3,913. So it's a lot cheaper. But keep that in mind. You're not gonna stop making payment after 20 years. We designed it so that you are making payment for your entire life. Now, because we designed it as such, I thought it makes sense to add waiver of premium. You can add a waiver of premium for 20-year payment also. It'll bump up their premium. But if you do the waiver of premium, here's what's going to happen. Let's say they're making $2,622 a year. You could convert it to, you can do the monthly payment too. Now, if you're making this payment and if either one of them is struck with long-term care condition, you need a caregivers and you need to have a help up facility, then the benefit will be paid out, $5,000 per person. Long-term care benefit will be paid out to cover their costs. Now, what this waiver of premium will do is that it'll allow the client not to make that $2,622 of payment because they're in that condition. They're not capable of making payments, right? So insurance companies taking over, so you don't have to make a payment. But waiver of premium is only tied to whole life premium. It is not tied to the continuation of benefit rider cost. So if you're struck with that condition and you still have death benefit, that means you have to pay $1,291 a year. instead of 3,913, which is still good. Still good. Now, if Jane and John, their situation is so bad, they either of them or both of them spend up all their $166,000 death benefit in the form of long-term care benefit. If that happened, the continuation of benefit kicks in, which will continue make a payment of $5,000 long-term care benefit to each of the insurer. And here's another thing about this continuation of benefit rider. What they'll do is that if money is coming out of this rider, long-term care claim is coming out of this COB rider instead of death benefit, what will happen is that it has built-in waiver of premium within the rider itself. So when you are struck with this condition, then you do not have to make a payment of $1,291 a year. So you're completely set free from making payment. Now, for the sake of argument, I don't think it'll ever happen. If they got recovered from their condition, do they still need to make a payment on 2,622 and 1,291? The answer is they only need to make a payment of 1,291, but not 2,622, because 2,622 is no longer needed because death benefit is already depleted, right? You do not need to make a payment of it anymore. The premium drops down to 1,291. Here's another situation that I can think of. Let's say John got into long-term care condition. He used up all of $166,000 of death benefit, and he was still getting a little bit of money from continuation benefit rider. That's about $5,000 a month, still drawing that claim, and he passed away. Now, once he passed away, there is no more payment from continuation of benefit because Jane isn't sick yet, right? So after that happened, the Jane needs to pay $1,291 for herself, the long-term care for herself. But she does not need to make a payment for 2,622 because death benefit is already gone. But she has lifetime coverage with the COB rider, which is about a little over $100 a month. And if later on in her life got struck with a long-term care condition, she too will receive up to $5,000 of the claim benefit, long-term care benefit from COB rider. And while she's receiving benefit from this continuation of benefit rider, she does not need to make payment of $1,291. And for some miraculous thing happen and she got fully recovered, then she'll get back to this policy by making $1,291 a payment every year. And then when she got struck with this condition, then she does not need to make a payment, but she'll get $5,000 a month long-term care benefit. So that'll wrap up that illustration. I think it is very straightforward. So I'm going to take your question.